welcome everybody to our Tuesday afternoon barometer readings webcast. Lots going on in markets. We're waiting on a Fed cut. Everyone's back to school and it feels like a new year. September is always an interesting month. What we thought we'd do today is take a fly around the world from a top-down perspective. We're going to take a look at all the major asset classes, what's changing, what's not. We got some pretty persistent themes in this market. And lots of discussion around valuations of U.S. stocks. But the fact is, we always have to remember, as they say, the market can stay irrational longer than you can stay solvent. It does not pay to try and make decisions on what you think something should be worth. It's what the market tells you it's worth that matters. So we try and piece together factors from all of the major moving parts in the market. And cobble together portfolios that are relevant in the current market environment. And that's always a bouncing ball. The world changes. And so without further ado, let's jump in and go from the top. I got James Callahan on with me today. We're going to talk a little bit about technology and a couple of our positions there and what might be changing. But off the top, the S&P 500 has been in a structural bull market since 2013. It's been working its way higher. It's been about 12 years, which is not a short period of time, but bull markets can last a lot longer, as we saw through the 80s and 90s and through the 50s and 60s. We've stayed pretty consistently above this rising 200-week moving average. And we've been tested a few times, including COVID and slowdown in 2021-22, and of course the sell-off in the spring of this past year. But here we are, basically, at new highs in the S&P. Now, seasonally, this can be a tough time of the year, and we watch for it, and we've talked about it over the last few weeks. But pretty hard to get wound up. Now, this is the S&P, looking at it through a different lens. This is the sell-off that we saw in April. The S&P sold off 21%, and of course rallied back to make new highs. And since we made new highs, the S&P is up about 7.4%. So that has been making new highs really since the middle of summer. And there's no sign that that's coming to an end. We're trading above all the rising moving averages, the 200-week, the 50-week, 21-week, and the 8-week moving average. Days. And when we look at the NASDAQ 100, it's a similar picture. Market sold off 25% in the month of March and April. We rallied back to make new highs, and since then, market's up 9.9%. Again, today trading at new highs. And we're trading again above all the moving average, 200-day, 50-day, 8-day, and 21-day moving average. So that's favorable. Now, we are in a market where correlations have been falling, meaning the market is sorting the good from the bad. There's no big macro factor that's driving behavior and everything. If we take the equally weighted S&P, it sold off 17% into the spring, back to make a new high. We're about 2.6% above the high from February. But in fact, we're right in and around the highs that we made in December of 2024. So, on year, the equally weighted S&P not up a ton. And the equally weighted NASDAQ, again, down to security selection, relative strength versus the S&P has been pretty darn weak for the average stock in the NASDAQ 100, which means it's a stock picker's market. And we think that that's important because U.S. stock market's been a great market for a long time. We always watch breadth. And of course, there's been lots of chatter around valuations. And so if we take a composite of a bunch of the different valuation metrics, you can draw a picture to say, U.S. market is not inexpensive. These were basically secular highs in the market. But as I say, there's no sign that anything's changing, other than we have some strength in global stocks. So this is price performance of the U.S. stock market versus global markets. And you can see, obviously, wonderful performance from 2007 until this past year. Now, U.S. market has come down a little relative to global stocks, as we've seen markets like MSCI All World ex-US, 1, 2, 3, 4, 5 months making new highs for the first time since 2008. And if we put that under a microscope, I think this is interesting. Sold off 14% in the spring on the tariff news. Strange that it was less than US stocks sold off through that period. We came back and made a new high, but since we made new highs, the all world index up 13%. So that's interesting because that's a change in behavior and it's something that we want to stay on top of. If we look at the MSCI Eurozone index, making monthly new highs. India, after some consolidation, looking pretty bullish. Japan, we've talked about, just continues now to make new highs, but just keep in mind how early stage this new bull market is since we took out the highs from 1991. So we don't know where things are going to go, but from a risk reward perspective, that's not bad risk reward. Last bull market, Japanese market went up 2,800% over many years, 1968 to 1989. Asia's had a great couple of weeks. This is the year Asia 50. These are daily moves, boom, 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 boom. Relative strength making a new relative high today. If we look at same statistic, index sold off in the spring, came back, made a new high, but now up 20% since it's made its new high. So I have to think that there are some flows going to global stocks that were not going to global stocks previously. And we like to have the wind at our back in that case. Africa continuing to perform well. Of course, South Africa benefiting from what's happening in precious metals. But frontier markets in general behaving pretty well. Latin American markets and South American markets, continuing to march higher. These are great monthly bars that we're seeing. Very consistent breakout. At some point in here, we're going to get consolidation, but really no sign of that yet. This is the emerging markets ETF PIE. Again, relative price performance rising versus the S&P, and the TSX is a similar picture. So don't want to beat a dead horse, but after we saw a turn in the relative performance of ex-US stocks, we did consolidate for a few months, but you can see this monthly bar now popping its head up and breaking out. So it looks to me like we're seeing a reacceleration in momentum in global equities. Of course, I think most of the clients who are on the call know we've been taking our global exposure up. We started with a 5% weight, and in equity-like accounts or tactical accounts, we're closer to 15% today as a total weight. And I think it's very, very early stage. Also, we're watching Canadian equities because the makeup of the Canadian market is quite similar to the makeup of the MSCI All World ex-US index. And the TSX, now outperforming. It's a combination of currency. It's a combination of stock performance and currency, a combination of, the sectoral performances. The TSX and global indices have a very heavy financials weight. And we know the financials tend to do well when the Fed starts to cut and long rates are staying sticky. The difference between the short rates and the long rates, their opportunity to make a margin lending money, certainly favorable. But the breadth of advance for global equities, having come out of many years of sideways performance, is important. 85% of companies trading above a rising 200-day moving average. Valuations, still sort of favor global stocks. But again, we talked with James about this a couple weeks ago. Keep in mind that some of the strongest parts of the US market are trading at a high multiple. But they're trading at a high multiple because they've been very predictable and the growth has been very persistent. But certainly global is giving some diversification. So since we launched the global fund in December of 23, the equal weight S&P in Canadian dollar terms, our reference currency, is up 27%. The index MSCI All World ex-US up 39, and the barometer global equity fund up 51.9. So this is working out quite well as a backdrop for portfolios. In fixed income world, we've been working our way higher in yields. We're watching inflation. Inflation is coming in a little bit more muted. in some of the most recent readings. US has had a little bit higher PPI data, but the bond market continues to have, a bit of a tough slug. 30-year yields have been going higher since 2020. They've been going higher sort of around the world in UK and Germany and France and Japan. Long-term bonds continue to make lower lows and lower highs. Now, we've seen a little bit of a bounce in bond prices over the last week or so. We'll watch that. We are still working with a series of lower highs. So I consider this still in a downtrend. Moving averages are still working their way lower. So we'll see how they react after the Fed cuts. My worry is that there are people who would say there's not tons of evidence that says they need to cut in a hurry, although the jobs data has weakened and the unemployment claims have picked up. And so when that happens, Fed's dual mandate is to make sure they're protecting employment. So we'll see how the market reacts. On commodities, commodity prices, of course, continue to march their way higher. These are weekly bars, so trading above all of the long and short-term moving averages. This has been happening since the bulk of central banks stopped hiking rates in 2023. And, commodities, continue to work their way higher. We've had a major shift here. And I think in general, they continue to be relatively underowned. They're a small part of the S&P 500. Materials about a 3% weight. Energy is less than 3%. Gold continues to mark its way higher. That's probably the best representation from the commodities universe. Been very, very consistent. We highlighted recently that foreign central banks now are holding more gold as a percent of their foreign reserves than US Treasury bonds. And part of that is because gold prices have moving up and bond prices have been stagnant. But it's also because there has been fairly persistent buying, in central banks around the world. Where we are in the scheme of this bull market, we think it's still relatively early days. Last bull market, went on 71 months. And there was 3 distinct legs to the rally. You got to between 80 and 100% above the 200-week moving average each time it got stretched. In the bull market of the 1970s, it went on 93 months, got to 155% above the moving average. It got to 300% above the moving average. And if we look at today, we're up about 80% over about 18 months. So very short relative to the previous 2 bull markets. We're about 60% above the long-term moving average. So there's room, I think, for this to continue on, and silver certainly has joined this. So what do we take away from that? Well, if you think that governments are going to continue to fiscally stimulate, and if monetary policy might err on the side of being, a little bit more friendly, then you might want to own an asset that is scarce. And companies, equities, have the ability to raise price. So equities make sense. They would be performing well around the world. And commodities are scarce and are seen by some as money. And so it makes sense that we are seeing money flow in. Although private investors largely not there, it's been largely central banks adding gold to their reserves. But again, in the scheme of long-term bull markets, the move higher in silver, has been relatively short-lived relative to the previous 2 bull markets in the 70s and after 2000. So gold relative to the NASDAQ 100 seem to be going through a regime change. And we have been, holders of gold and gold equities, along with, some of the leaders in technology. Copper looks as though it's trying to make a turn here. Certainly the equities have been getting better. And if we look at it in just broad terms, pick your poison. Which asset class do we want to focus on? Equities are performing around the world, and commodities are outperforming bonds. Both of those things are assets that you would want to own if you think there's risk of the devaluation of your purchasing power with currency or inflation. And until this changes, it says to me that the market thinks inflation is the greater risk. And if we compare commodity returns versus the equal weight S&P, over the last 12 months, it's been getting better. We'll see whether we break above these highs from 2021 or 2023. But that would be the next sign that we have another leg coming in front of us. Now, a lot of this has to do with what's going on in the US dollar. We've been highlighting this for a while. US dollar has been going through a topping period. This is 2022. This is as the Fed was tightening more dramatically than other central banks, made a lower high. We broke these previous lows, and the market has been consolidating lower this past week. US dollar broke to new lows. So when I look at the technical picture here, it tells me that likely US dollar is moving a few percent lower from here versus euros. So this is euro versus US dollar is strengthening now. And Canadian dollar is stronger, and pound sterling is stronger, and Japanese yen is stronger. So with global government bonds outperforming treasury bonds, global currencies outperforming US dollar, and global stock markets outperforming US stock markets, it's safe to say it's possible that we see a continuation of money working its way into global equities and into commodities. And so our job is to kind of pick our spots. So our job isn't to be everywhere. We've got to find leadership. I would say leadership today are in things that benefit from a weaker dollar and are things that protect from inflation. We watch for change. And if we get change, we're happy to make changes in the portfolio. In the absence of leadership, well, of course, we can sit on cash, but we know the risk to holding cash in an inflationary environment is that your purchasing power gets inflated away. So our whole world is about finding asset classes and sectors and themes that are showing expanding breadth, where more and more securities are participating. As long as that's the case, it's a healthy market. There are no bear markets that ever take place when breadth of an advance is expanding. So if there's 100 stocks in a universe and over time more and more of them are participating, means the sector's bringing in new flows and there's money coming in behind you as an investor. And where we can find areas of the market that are showing expanding breadth, and that's 70% of return, get the asset class and the sector right. And then we can find securities that are good getting better, that have financial characteristics that highlight something's changing for the better, an acceleration in revenue or an improvement in margins, or strengthening balance sheet and price behavior that shows relative price performance versus its peers or versus the market. That's where we should be focusing our investments, and where we find securities that are good getting better in parts of the market that are showing expanding breadth. That's what our portfolio should look like. And we stay that way until we see things we own start to see deteriorating breadth, which would be a sign to us, well, it might not be the leaders that sell off first, it's the weaklings. But if enough of the weaklings sell off, sooner or later, the selling comes back and hits the leaders. So as we sit today, we're in a pretty good spot. Breadth has been improving, so we don't have a ton of cash. We do have stop losses on all of our positions. And if things were to start to change, then one by one, you'd see us raise cash. But when I look at the breadth readings, the percent of stocks in uptrends in the US continues to expand. And the percent of stocks in uptrends in global markets are expanding. And the percent of stocks in uptrends in Canada are expanding. Breadth is improving around the world. Percent of stocks trading above their 50-day moving average, expanding nicely in Canada and the US, pulled back a little bit in global stocks. And in the US, percent of stocks with positive momentum backed off a little bit. I talked about a lower correlation. There's strong stocks and there's weak stocks. There's strong sectors and there's weak sectors. We got to pick our spots. But the percent of stocks hitting new highs, versus the number that are hitting new lows is getting better. That's a sign of health. And the percent of stocks trading above their long-term moving average has been improving. That's a sign of strength. So I've always said, when a news event comes, it depends on the backdrop condition of the market as to how well it will absorb the news. Now, we're going to get a rate decision tomorrow. I think people think it's like a 70% chance that we get a 25 basis point cut. That's expected. It's possible you could get a 50 basis points cut, although some investors might be concerned by that. It might seem that the Fed was afraid that things were slowing down more rapidly. There's a possibility that the Fed might not cut, but that would probably be seen negatively. So the question is, what's the backdrop? Well, let's look at the sector leadership. So financials have been leadership since 2020. And the XLF ETF, made up of banks, insurance companies, fintech, and card companies, have been just marching higher. Big US banks, Morgan Stanley, improving relative strength versus the market, making new all-time highs yesterday. JP Morgan made new all-time highs today. These have been big positions for us. JP Morgan is probably our biggest financial position behind Fairfax. The Canadian banks, this is the equally weighted basket of Canadian banks. Well, they've been even stronger, making a new all-time high today, the aggregate of the five. Now, they've all reported their earnings, and we saw the results coming out. Bank of Montreal really has been flying since it reported its earnings. The one that was a little bit disappointing for us was National Bank, but on cue, held here at the 50-day moving average, held its long-term trend, has rallied back right back to highs. Global banks, Santander has been one we've talked about, trading better than 94% of all the companies in the S&P, made a new all-time high yesterday, down about a point today. But we think relatively early days for financials in Europe after coming out of a bear market that lasted over a decade. I thought this was an interesting statistic I saw this week. This is from our friends at Strategas Partners in New York. They looked at the drawdowns from all-time highs at the time of Fed cut. When the Fed cut with banks at all-time highs, and here's three occurrences, they had almost no drawdown. These happened during strong markets. July of 92 was coming out of the 1990-91 recession. January of 96 was coming out of a waffly year in 94, and same with July of 95. So these are not something I think that we should be afraid of. Banks are not telegraphing some kind of a problem. On the industrial front, we talked last week about the fact that industrial has been consolidating a little bit. Their relative price performance has been waning. And that's because on one side, we have very weak performance from transports, which we've been avoiding. And on the other side, aerospace continues to perform well everywhere in the world. GE Aerospace went out tonight at new highs, up 2.2%, trading better than 90% of companies in the S&P. This has been a great call, James, if you're sitting there listening. And the European defense stocks, of course, firmed up over the past week with the incursion of Russian drones into Polish airspace. Clearly there's a view that there's going to be increased spending going on across the EU for defense. In the basic materials, the gold stocks, gold producers, have been marching on to new highs. These are weekly bars, so we've now had 8-9 weeks in a row where the group has been up. We will correct at some point, but so far the ETF holding the senior producers is trading better than 94% of companies in the S&P. It's by far the best sector in the market over the course of the year. And companies like Kinross and Agnico, continue to look really, really good. We take encouragement by the fact that the gold stocks are outperforming the metal itself for the first time in a long time. And generally in a bull market, the gold stocks ultimately do outperform for quite some time. So, we watch these groups. Copper continues to improve. Hudbay which we've talked about as an intermediate producer, has had 2 giant months here, breaking out through this consolidation range and reversing this long downtrend that's been in place since 2007. The metal and mining ETF, now 3 months having made new highs, is very early stage bull market. We now have strength in some steel stocks and some various base metals producers. The uranium stocks 4 months into making new highs, going back to 2014. And staying on the commodities theme, interesting today, the Canadian energy sector ETF XEG broke above the range that it's been in for about the last 12 weeks. So we've talked about the fact that we've been consolidating and we may see these turn. The leading stocks are leading. Imperial Oil, which is our largest weight in energy, is up about 116% since July of 2022, making a new all-time high today. But to keep it in context, up 116% pales in comparison to 950% in the run between 1997 and 2008. So again, still pretty early days bull market. And we've added Tamarack Valley over the last couple of weeks. So I asked Amit if he could jump on today. He's got an appointment. He was unable to do it. Tamarack Valley is a leader in the Clearwater, which is a very prolific zone. In the Clearwater, the producers have been using water flood technology to extend and enhance the reserves they have. It looks like Tamarack Valley has sort of 10 to 12% production growth going out for the next several years. Their cost of production is about $40 a barrel. So it's a very low cost producer. And you can see, relative strength has been building here. Frankly, if you took a look at the long-term chart, it's just breaking out above multi-year highs. So 2.7% dividend that's been growing really nicely. Once they pay down a little bit more debt, they intend to double the amount of their cash flow they are going to put towards dividend increases and share buybacks. That'll be similar to Imperial Oil. The common characteristic in a lot of these resource companies is that they focused on paying down their debt and they're committed to returning capital to their shareholders. So we've talked about the fact that in a world where there is inflation, we need companies that generate a growing stream of cash flow and that show a willingness to share that cash flow with us, the investors. So if there is inflation in the commodity price, their price that they get for their goods goes up tomorrow. So we think that we're going to get great dividend growth out of these big cash flow producers. And Suncor would fit in that bill, and CNQ would fit in that bill, Canadian Natural Resources, and certainly the copper producers as well. So moving back into the U.S. market, communications sector, which houses all the social media companies like Google and Meta, made another new high yesterday. The relative price performance has picked up over the last 2 months. We've had a great run with Google, but again, this is about being selective. Google is consolidating its spot as a leader in AI, and certainly with their data around search, it will give them a lot of data to work with. Meta continues to perform well in their application of AI into things like Instagram and Facebook. Our holdings in the gaming companies, Take-Two Interactive, as an example, James has done a great job in having us positioned there. And then moving into some of the global stocks, Sea Limited, which we added across portfolios a few months ago, has both gaming and e-commerce. 70% of their revenues in Southeast Asia, 20% Latin America, and digital entertainment is 71% of their revenue. So there's actually quite a lot to do in communications globally. In our global fund, one of our biggest holdings is Baidu, which has just had a spectacular 2 weeks rally from $90 to $124. My guess is, again, that's relatively early stage new bull market. Okay, so technology. Technology has been leadership for a long time. There are some world-beating companies in the group. Group sold off 25% into April. It has, made nice new highs since. Not all of them are behaving the same way. When we look at rolling 65-day correlations, or the degree to which they're acting the same as each other, you can see the market is sorting good from bad. And so the winners are winners, and there are some newfound losers. So we got to watch this group carefully. Now, the semiconductor sector, if we look at the market cap weighted index of semiconductor producers, where the biggest companies get the biggest weight, hasn't made tons of progress. But if we look at the smaller semiconductor companies, James pointed out a while ago that they were really waking up. So James put a position on not that long ago in SiTime. James, maybe you could talk a little bit about SiTime and Lam Research.
Yeah, thanks, Dave. I'm happy to, and thank you for the shout out on some of the other positions that you talked about. Those have been good winners. So, SiTime, it's a name that we've followed and owned on and off really since 2020, shortly after they were spun out of a bigger Japanese semi company called Megachips. So, very broadly, what they do is make silicon-based timing chips. So, every electronic device that does some sort of calculation needs a timing chip to ensure that electricity is flowing through it at the right rate. Traditionally, timing chips are made out of a quartz crystal, which are pretty cheap and they're good enough for most applications, but SiTime makes theirs out of silicon, which means that the timing chip itself can get much smaller than a quartz one could, and it can withstand higher G-forces, extreme temperatures, which makes it pretty useful in specialty applications. So a SiTime timing chip comes at a much higher price than a traditional quartz-based timing chip. So there isn't really anyone else who's figured out how to do silicon timing. So SiTime really owns the market in these edge use cases like rocketry. They sell into EVs, places where timing chips have to withstand a lot of heat and a large amount of energy. And when the product's form factor has to be small, SiTime also wins business. So they sell to SpaceX, Tesla, Raytheon. Their largest customer is Apple. When they started selling to Apple in one of the first gen AirPods, because the form factor was important, they needed it to be very small. Since then, they've been included in a smattering of some different Apple products over the years, including some iPhones, not all, some AirPods, the Apple Pencil. And over the years, that's been a very important relationship. That business can be pretty lumpy, but now it seems like they're going to be doing more business with Apple than they historically can, which should be good for the stock. So one of the Apple products that SiTime now sells into that I think does have the most runway for growth is Apple's cell phone modem. So in the past, Apple's had to pay Qualcomm to develop the modem for the iPhone, which is the piece that allows the phone to connect to Wi-Fi and Bluetooth. Apple's been working to bring this in-house over the last few years. So last year they included their own modem in the iPhone 16 SE, which was the cheaper version. And that's important, obviously, SiTime sells into the Apple modem. I bought SiTime in the equity pool ahead of the product unveiling that Apple did last week. It was pretty widely rumored that Apple was going to include their own modem in more versions of the iPhone 17, and that happened. So with iPhone 17, Apple's going to include the modem in the 17 Pro and the 17 Air. Eventually, they'll include that Apple modem in all iPhones, which is good business for SiTime. So it's not clear how big that business will be for them. SiTime management speaks very conservatively, especially about their Apple business. They won't even acknowledge Apple as their largest customer, actually. But directionally, it's really good. SiTime will likely make its way into other equity-oriented accounts in the next little while. At the moment, there's just not room for it. So it's now in just the pool and is up about 15% from where we bought it. So that's good. Speaks to the smaller cap semi exposure, and that's been a good winner for us. And then Lam Research, it's smaller down the cap scale than a name like Nvidia and Broadcom, but it is still $150 billion market cap roughly. And it's just nice. Alongside SiTime, it does kind of highlight that there is money to be made outside of the specifically AI-related semiconductor names. What Lam Research does is pretty technical. This one is one that we've owned for longer. We've owned this one really since the middle of the year. But their business is technical. Very generally, they make the machines that make semiconductor chips. So they sell very complex, very expensive machines into semiconductor foundries that allow the foundries to etch the silicon and produce the chips. So this name's owned more widely by us. It's in most of our equity mandate accounts. Great business. They have a great moat for in terms of product. They are a bit beholden to the semiconductor cycle, so it can either be feast or famine. Right now, the stock's been trading very well, as you can see from the chart, for a few reasons. One of which is that it's been acting as a bit of a proxy for U.S.-China trade relations, which are in a better spot, really as a better spot than they have been at many points throughout the year. A third of Lam Research revenue comes from China. As the years progressed, as it seemed more and more likely that their China revenue won't be negatively impacted by U.S. export controls, and now that they've actually been growing the China revenue at a pretty fast clip, it's just a better situation for them. Alongside that, their non-China business is doing quite well. The semi cycle XAI is in a pretty good place right now, so they do seem to be setting up for a strong 2026, and management team has been making the rounds at various tech conferences, speaking to that effect. So that's another good one for us.
Well, James, certainly with the correlations dropping in the tech sector, it's been really important to pick the right companies, and you've been doing a great job.
Thank
And
you.
I want to thank you for that. Just highlight a couple of those names. Moving on, energy, does appear to be waking up, and the XEG made new highs here today, and with um, uh, about 65% of companies trading now above long-term moving averages. We're more interested. Um, Nice move today in the TSX Capped Energy Index, and Imperial, just marching along, and Tamarack Valley, the same thing. On the have-nots, these poor investors in staples must be feeling pretty left out. Um, Markets had a pretty good rip here since early in 24, but relative performance here in this group has been really weak. Part of it, I think, has to do with Ozempic, and spending on high margin products, junk products, really not winning. Um, we did own Loblaws and have owned Loblaws for the better part of 2.5 years. It's been a leading stock, but we came out of Loblaws this past week. Great company. What they've done with Shoppers Drug Mart has been remarkable. Stock looked as though it may be just consolidating the gains. But given the fact that we only need 25 or 30 positions in a portfolio, and there's a couple thousand that we could choose from, when something starts to underperform, we move on. So broke the support here in the low 50s, and we've moved on. It's now trading only better than 48% of companies over the last 52 weeks. Utilities also continue to be a relative weakling. REITs continue to be a relative weakling, and pipelines continue to be a relative weakling. Now, the common characteristic is that they are all defensive sectors, and they all are higher dividend sectors. And we've talked now for the last couple of years that high dividends can be enticing, but if they're not growing, they don't help offset inflation. So we really do continue to favor dividend growth, and our average holding in our income portfolio today is seeing about 18% dividend growth. And I think that is one of the reasons why it's performing well. From a sector perspective, we look at the distribution curve of all the major sectors. On the right are the ones with the highest percentage of stocks in uptrends, and on the left are the sectors with the lowest percent of stocks in uptrends. We want to be focused down here on the right-hand side, and we see a lot of industrials. We see a lot of financial services. We see materials, and it's just a very clear picture. If we look at it this way over the last year, from middle of September 24 to now, from a weak performance perspective, below 100%. pipelines, high dividend, staples, REITs, long-term bonds, and healthcare. These are the weaklings. From a strength perspective, gold producers, uranium producers, metals, European financials, industrial companies that are in the aerospace business, communications, Japan, Canada, S&P 500. So look, we're trying to focus our attention in those areas that are showing strong relative performance, trying to pick our spots. And the common characteristic I would say is cyclicals relative to defensives. Companies and sectors that are economically sensitive continue to make new relative highs. So my takeaway from that is it does not look like the US is headed for recession at this point. Market doesn't believe it is. We have some Fed loosening coming, which could be supportive of risk assets. We're not overbought. Overbought is when we get above this red line and then you sometimes see some consolidation. It's improving on a relative basis, but not overbought. So our sector weights would be, would line up with that. Financials now almost 25% of our total, 23% of our total assets. Industrials are at 15.7%. That's up from a month ago at 11. Materials are at 12.7% versus 1.8% of the S&P. Technology is about a 12% weight. So it is a significant underweight, but I would say that some of the choices are punching way above their weight. Communications continues to be a little bit overweight. Energy shows here at 8%. I know we added some additional weight today, so we're probably closer to 10 versus 3% in the S&P. And on the other side, consumer discretionary, we are still cautious about, because with residential real estate prices weakening across multiple markets in the US, and the fact that consumers have been using their homes still as piggy banks, especially here in Canada, we think that could be an issue. Healthcare in general, underperforming, 9% of the S&P. You got a 2% weight. Our staples weight got lighter with the loss of Loblaws. Our utilities is almost negligible, real estate negligible, and government bonds negligible. So we're pretty happy in general with how things are going. The equally weighted S&P, since this team gelled together in the middle of March 23, equally weighted S&P is up 42%. The MSCI All World ex-US is up 54. Our equity portfolio is up 58. The aggregate bond index is up 11, and then high dividend payers ETF is up 24. Our income strategy is up 45% over the period. So things we're watching for signs of risk: credit spreads. They do not appear to be getting any wider. Certainly as the S&P is making new highs, credit spreads are hitting new lows. The excess return bond investors are asking to buy a corporate bond versus a government bond. They're comfortable with corporate risk. And volatility continues to be right down in the low end of the range that it tends to be in during a cyclical bull market. So we'll see what the Fed has to say tomorrow. We'll see how the market reacts. Coming into it, I think the market's on pretty good footing. If things get more difficult, we can always get more defensive. But we're trying very hard not to say what the market should do. We're trying to make sure that we are lined up with what is happening in the market. And we'll watch for things that need to change as we go. So with that, why don't we see if there's any questions? There's my daughter calling. Let me just take a look, see what we've got. Robert is asking, which do we prefer, KWeb or EEM? Well, let me see if I can throw a chart up here, and we'll take a look. Okay, so I think we can see this. Okay, so KWeb is an ETF that holds a lot of the communications and technology stocks that are more China focused. So Tencent, Alibaba, JD.com, and so on. It's performing really well. It's very focused in sort of the more web-based companies. Relative strength has been improving nicely. I would say that looks quite different than the EEM, which is the emerging markets ETF, which is really across a broader universe of sectors. So we own the PIE, which is an actively managed ETF. Relative price performance has been a little stronger. This is made up of, a lot of holdings across emerging markets. They are all sort of technical leaders. And then, of course, in our global fund, we own single names. So I don't see a problem with KWeb, but I do like the diversification that I get in either PIE or EEM. Andrew is asking, which indicators do you use to set stops? Well, we use point and figure price charts. And point and figure price charts I can spend some time on in another webcast. They were invented by Charles Dow back, I don't know, a little over 120 years ago. And they line up the battle between buyers and sellers and very clearly mark out when a stock is in higher highs and higher lows, or conversely, lower lows and lower highs. And we put a stop where the chart is breaking down. In the simplest of terms and short-term basis, we use moving averages to watch, but of course, a lot of people watch moving averages, so we use a confluence of those two things. But selling discipline to us is really, really important. Alejandro is asking, in the 70s and in the 2000s, gold had a bull market cycle. Bond curves went very steep and inverted, and for more than a year, and then steepen, and there were flows into international markets. Those three indicators only happened at the same time in those periods and preceded difficult recessions that the US has experienced. So I think that we recognize that, and we watch. No market cycle is the same, but they do rhyme a lot. The fact that the US dollar is weakening and did weaken through both of those periods, is something to watch. I don't think looking at the cyclical parts of the market, we can point to a recession. What I do think is that is a bigger factor today is that governments have shown they have no discipline around the amount of fiscal stimulus they're using in the economies. And so, there's a lot of potential inflation out there. So we'll watch for signs that the U.S. market gets into difficulty. I can't point to that right now, and so we do have a lot of U.S. stocks, and they're behaving really, really well. But I do think we have an opportunity to diversify some of that risk away by owning other currencies and owning, some big companies that are lesser owned and certainly, priced more favorably. Further to last week's webcast, we were asked about MDA Aerospace, which is a company that we do own. And the questions were we stopped out. We used the 200-day moving average as our stop point because it had held the 200-day a number of different times. So far, it's held the 200-day and seems to be trying to make a turn here. The premise was that the business that they lost as a surprise from and I'll think of it in a moment, the U.S. satellite company is a small piece of their order book. And while it was like $1 billion of backlog, their order backlog is closer to $6 billion. And we are still very early stage in the space economy. And we think MDA has a great opportunity. So we think that the market priced that loss and more. And so long as we stay above the 200-day, my guess is we're gonna remain there. On Loblaws, you asked the question, any reason why there's a recent drop off in Loblaws? Look, consumer staples are having a tough go, and there are questions as to how long margins can continue to expand. We're also watching Dollarama closely. It's been a great position for a long time. We continue to be there, and I'm not seeing a break here. It looks more like a consolidation, but we'll see. We're not adding new positions to consumer staples. I think that's all the questions. Jerry showed the same slide as last week for the weekly. I may have done that. Let me just take a look and see if I forgot to add the new slide. Yeah, looking at the new, sorry, if I didn't put the new slide up over week, there actually is virtually no change. Industrials went to 15.7 from 10. Financials are the same weight. Materials are the same weight. Information technology is the same weight. Staples is a little bit lower. So no major changes there. And does Barometer invest in any non-equity type of inflation hedge, for example, farmland? The one thing that we do is we have quite a successful fund that invests in music copyrights, songwriters' copyrights. We own the songwriters' copyright for virtually all of the Weeknd songs, a lot of Drake songs, a lot of Justin Bieber songs. It's a large catalog, close to $200 million worth of copyrights. It started yielding us about 6.5% a year. Now it's up to about 9.5% a year. It's return of capital. And the inflation hedge that is unique there is that, first of all, streaming subscriptions are growing, and the copyright holders get paid 70% of the streaming subscription fees. And second, when Spotify decides to put their price up by $1 or Apple Music puts the price up by $1, we get a raise. So that's an inflation-adjusted income stream, and the counterparty that pay us is Spotify, Apple, Google, Instagram, TikTok. And so it's a very low-risk business, no economic sensitivity. And if anybody wanted any information on that music fund, it's a dynamite complement to an equity portfolio and to certainly commodity prices. Gold is still rising. Miners selling down. I mean, gold miners went down a little bit today, one day. I'm not too worried about that. I still think it's relatively early days. And question on Lululemon. Look, Lululemon is it's kind of a broken stock. So all the estimates for 2026 went lower. All the estimates for 2027 went lower. Estimate for earnings growth in 27 is a 0% earnings growth. When a growth stock stops growing, it's a troubled stock. So I would move on if you own the stock. And one more question was on Honeywell, and we like that space. The industrial controls businesses, but we've been focused our attention in GE and in GE Vernova.
Maybe I can just jump in on the Honeywell. It's one that we followed too. They do plan to spin out the aerospace business into its own company next year. So that could be pretty interesting, to look at the technical picture for the stock market saying it's not time yet. So it would be a bit early to get involved with a view on that now, but eventually that one should be pretty interesting. They are one of the last remaining industrial conglomerates, and that's been a pretty powerful theme, the breakup of the big industrial conglomerate like we've seen with GE. So that one could be interesting, but not for right now.
Yeah. Oh, and I see that there's one more question just on Constellation. And, we do not own Constellation. We don't own a lot of software, frankly. We own Microsoft, which has been a great position. But, it continues to do the right things. It's making new multi-year highs, continues to work its way higher. Constellation has been a great stock over time. It's difficult for us because it's not the most liquid stock. And you can see that the relative strength really has rolled over here. It's broken below the 200-day moving average. It tried to rally back up to it and failed. You now have all of the moving averages moving lower. I'd be a little careful here. Relative strength, trading better than 18% of stocks in the S&P. And the estimates for this year are coming down. So nothing for us to do there. I want to thank everybody for joining us. We love doing this every week. Hopefully it's useful. Nice to have the questions. If you've got questions that we're not answering, bring them up. We'd love to hear them. And if you're too shy, we'd be certainly happy to have a phone call with you. If any of the things that we're talking about make sense to you and you'd like to have a bigger conversation, let us know. We're a growing business and we like to meet new clients. So thanks so much for taking the time, and we'll talk to you again next week. Thanks, James.